Greetings, it's Charles Thomas from Intrepid Eagle Finance, and I'm here to talk about what happened in the market and the economy during the third quarter of 2024. First, some positive signals. Inflation fell. Still not completely back to normal, but inflation fell. Went down to around 2.6%. Not quite to normal, but much, much better than what we have been in for the last couple of years. We also saw some of the recessionary indicators, so the things we see that indicate a recession, they're not flashing red. Another good thing. Parts of the yield curve have uninverted. So in other words, usually we have what's called a regular yield curve. It's been inverted for quite a while. We've finally gotten back to a point where it's closer, not completely, but closer to normal. That's another good thing. Looking out at some cautionary things like to look at, good and some things that might be places for caution. Some of those signals, the Fed has moved and they're less focused on inflation than they have been for a while. They've turned their focus now toward unemployment. Unemployment has started to tick up a little bit. So this is what the Fed is putting a lot of their attention on, a lot of what they're watching right now. Hard to miss it when you look at the news, but geopolitics, election things like that, that is also weighing right now on the minds of the markets and investors. And then finally, China is having some problems. They put a big stimulus package in play. It's unclear what that's going to do, if anything. We'll just have to see what that looks like. But that is another case where potentially negative effects out there. Looking at some numbers that stood out to me from this past quarter. First one is what we call the Fed policy rate. The Federal Reserve, after keeping rates the same for a long time, finally lowered rates. We saw them lower that by 0.5% in September. We've been waiting on that for a while, and they went ahead and instead of just moving a quarter point, they moved what we call 0.5% or 50 basis points. Also saw inflation come down. Again, not completely back to what is normal or what the long-term average is, but we're heading in the right direction with that. 26. That is the number of months where we saw the yield curve for interest rates be inverted. That's a long time. Generally, when that does happen, or when we've seen that happen in the past, it's much more temporary. To see it go for that long is very unusual, and we finally saw that start to normalize. Again, not completely normal, but start to normalize. 3%, that was the lowest of all the different stock measures we look at for the quarter, which in contrast is pretty good. We'll talk more about that in a little bit. 15% of all the different segments of the stock market we look at, real estate was the one who did the best for the quarter. And then lastly, 35%, so roughly a third, is the amount of the top 10 stocks of the S&P 500, how much it makes up of that part of the market, which is very, very top heavy. That has been the case for a while, and that continues to be the case. We would prefer that to be a little bit more diversified or a little bit more widespread when we see how the markets have gained. But it's just something to be aware of. If you've seen this presentation in the past year or two, you heard me talk about the Federal Reserve having their pace, pause, and pivot. So the pace was when they were raising rates, how quickly they were going to raise them, how often they were going to raise them. We knew eventually they would get to a pause where they would stop raising them. And that's where we held at for a long time. We got to the pause, and we knew eventually they would go back the other direction and lower rates. And that was this waiting period we've been in for a long, long time. And this whole cycle has been going on since mid-2022 when inflation spiked so dramatically. Now, the big question on that pivot when rates would start to go down is when it was going to happen. So if we go back to the beginning of this year, The general consensus among economists and market watchers was you're going to see rates go down very quickly in the year. You're going to see the Federal Reserve is going to lower rates multiple times throughout the year. The debate you were hearing was, is the Federal Reserve going to lower rates 6 times or 8 times throughout the year? We got through the first few months, then another month passed, another month passed. And what we saw is inflation continued to persist. So the Fed was hesitant to make a change and lower interest rates. We finally got around to the early fall in September, and then finally we saw that lowering happen that was supposedly going to happen at the beginning of the year. And that's just how different it can be. That's one of the reasons why we think about short-term predictions, even when there's lots of consensus and there's lots of certainty around what people believe is going to happen. This is a good example of how it often does not come to fruition, or it may not come to fruition in the way that people are predicting it's going to. This is one of the reasons why we don't advocate for trying to time the market and trying to tie investment decisions toward short-term predictions like this. Now, inevitably, the question that arises from that has to do with a recession. It's been a while, thankfully, since we've had one of those, but inevitably that question comes up around, are we headed for a recession? And I'm a big proponent of these are very difficult to predict, and there's lots of people who will predict a recession every month, and there's some people who will never predict one. And they're often both wrong. Now, although I think it's very difficult to predict, and there's not a perfect measure of how to look at those, what I'm sharing with you here are 4 indicators that are often looked at by economists and other folks as indicators of a possible recession. JP Morgan calls these the 4 horsemen of recessions. These are things that will sometimes, not always, but sometimes show a recession is on the horizon. If we accept that and we look at these indicators, they're not indicating a recession is imminent. Now, does that mean we're not going to have one? I don't know. But these particular indicators don't indicate that a recession is imminent. But time will tell. Now, we talked about that interest rate change that we've been waiting for a while and finally happened in September. And when you see that, that immediately affects any new bonds that come into the market. So the biggest bond issuer in the United States is the government when they issue treasury, bills, notes, and bonds. And when they change interest rates, that immediately affects the new ones that are coming into the market. But there's all these other bonds that are all already out there and already circulating. So the question comes up, what happens with those bonds when interest rates change? Well, I wanted to show this here. This is an example. This is a 10-year treasury bond. And the period I'm showing here is from July of 23 through September of this year. So about a 14-month period where interest rates were unchanged, but you still saw this particular type of bond. You can see how much it fluctuated over that period. And that would be my takeaway, I'd say, from this is even independent of interest rates that do have a big effect on bonds, don't get me wrong, but there's still all these other factors that come into play with how bonds are valued and how they can go up and down. That affects their return that we receive as investors. A little bit more on interest rates, looking at what some of the different measures of that look like. And now, as I said, these curves, as we talk about them, these yield curves, were inverted for a long time, about 26 months. They have started, not completely, but they have started to normalize. This is much more normal than what we have seen for quite a while. And that's a good thing. That's a sign of economic health when you have just a regular yield curve. And the whole idea behind that is if I'm going to commit my money as an investor to a bond and I'm going to have my money committed for longer, then I should expect to be compensated more for that risk that I'm taking on and by locking my money up, so to speak. If I'm going to commit my money for a shorter amount of time, then for that privilege, I'm going to be expecting a lower amount of interest to be expected for that. That's what the whole idea behind a normal yield curve looks like. And that's why the inverted one has been just such a strange phenomenon to have lasted for so long. Now, looking at some investment returns for parts of the market, we'll look first at bond returns. If I could show a chart like this to you every quarter, I would be ecstatic about it. Bond returns were positive for last quarter, year to date, and then over the previous 12 months. That's a fantastic situation. I wish I could always share that with you. When we look at those, the corporate bonds performed a little bit better than some of the government and other types of bonds, but just across the board, positive here. Very good news from this standpoint. When we look at US stocks, also, if I could show a chart to you like this every quarter, I would be ecstatic about that too. US stocks positive over the quarter, year to date, and the last 12 months. And you're looking at that last 12 months, every part of the market that we look at 25% or above, which is absolutely phenomenal. One thing I'll point out is the part where that was the lowest of the last 3 months was what we call some of the growth stocks. That has been the source of the biggest returns in the past up until this quarter. So that was a little bit of a change there, even though it was still positive and still a positive contributor. Now, one thing I want to point out, especially on the 12-month returns, is just how far outside the norm this is. When we look at the long-term average of the stock market, that's closer to 8 to 9%. That's the average. This is orders of magnitude above that, which again, I'm happy to see, and I'll take any year. But just keep in perspective around expectations around this, that every year is not like this. In fact, we know from the way the markets work, we have some years that are going to be down. And part of that, we accept those years so we can have the benefits of the years like this. We get those big benefits that contributes to growing and compounding over the long term. So just keep that in mind. We celebrate years like this, but just remember, not every year is like this. Now, back to interest rates again, big theme today. The question inevitably comes, what happens with the stock market when interest rate gets cut? What happens when the Fed starts to cut rates or when they do cut rates? Well, it's mixed results on that. You don't always see that. It has to do a lot more with what is the reason for those interest rate cuts. So the reasons given by the Federal Reserve right now are believe they have gotten past the tough inflation we had, and it's time to lower them. That's one reason. If you look at other times like 2001, 2007, those are cases where they have concerns about the economy and they want to be able to introduce some money into the economy to help stimulate business and hiring and all that stuff. Those reasons have a lot more to do with what we see there. And then that's why you see this chart just all over the place. It's less of a direct result from that and just more has to do with the environment for how stocks perform. Breaking out the US stock market by different parts, by their sector, see a lot of differences here. Again, overwhelmingly up across the board. I'll just point out, and I'll pick on technology a little bit. Technology was one of the laggards here. And that's notable because in the previous few quarters, we've seen where technology has just been an outperformer in a lot of cases. And if you go look at what's in the news, a lot of that has to do with news around what's going on with investment and expectations around artificial intelligence and a lot of what is going in there. You know, what we're starting to see at this point is a lot of that excitement has turned into questions from investors asking, when's the payoff going to come for this big investment you're making? When are we going to start to see some return? Time will tell on that. Now, I said before, I like celebrating years like this a lot, but it's good to keep in perspective when we have those good years that we still see some fluctuation happening even in good years like this. So we have lots of years where the market is up, but during the year, that journey over that 12 months, we still see some fluctuation, and at some point you see some declines or some drawdowns, they're sometimes called, in the market. So if we look back about the last 100 years on this chart, about 94% of years had at some point during the year a decline of 5% or more. Very, very typical to see. If we look at a 10% or worse decline, well, about 2 out of 3 years had that. And then you see it goes even more after that. Even in those years that are normal, we still see some volatility. Volatility, although we don't like it, is ultimately normal. It is a normal part of the way the stock market works, even in years that are very positive. It's just the cost of what we have to pay, so to speak, to be able to participate in the markets and get the benefits of the market, of which there are many, but there still comes a cost. And one of those is accepting some level of ups and downs over the course of time. Now, when we think about why the markets have done so well, there's as many opinions on that as you can count out there. But one of the questions I've seen posed more recently is around, well, is it because the US has more business freedom? Is there a reason why the US has done so much better than a lot of other places in the world? And when you look at that question, this is a study that the Heritage Foundation does periodically. They go look at some of the developed economies around the world. So think about places like us, United Kingdom, France, Japan, places like that. Go compare those, look at the business environment and say, like, well, how much business freedom do these different companies have? And the assumption I hear a lot of times is the US has the most business freedom, and that is the reason why our stock market tends to do a lot better. In actuality, when you go look at that, we're more middle of the pack when you go look at some of these developed economies around the world. There's a number of others that do better by this measure than we do, but their stock markets have not performed as well as we have. So if you buy into that methodology and you believe that, another way to look at this is we have done better, and that has been in spite of the amount of business freedom we have compared to some other countries. Something to think about. Speaking of outside the US, looking at international stocks also very positive, not as positive as the US, but again, I'd be happy to show you this chart anytime. Lots of good things here. When we compare how things did over the quarter and how things looked like, this is how it broke down. I'll point out 2 things on here. So one is, if you look at those bars starting at the left, Thailand did the best, but China did the next best. China is a bit of a conundrum right now. They're a bit of a tough nut to crack. So China has a big influence. They're a very big economy in the world, but they are having some struggles right now they're trying to work through. They're the People's Bank of China, their equivalent of our Federal Reserve, is dumping a lot of money and stimulus into the economy right now, trying to get some more activity going and stimulate hiring and business activity. Will that translate long term? We will have to see. Now, we're still looking outside the US. This was an interesting example I came across that I wanted to share with you. Looking at Japan. Japan had this interesting thing occur in August. So first week of August, they had a single day where their stock market declined by 12%. And I don't care where in the world you're at, that's a lot for one day. Now, one of the things we see happen a lot is our instinct is often, well, this has declined a lot. I want to get away. I want to sell this investment or what I've got in this country, this part of the market, whatever it is. If that happened, if that decline happened and you sold, this is a little bit of how that could have played out And then what we saw with the recovery after that. If I had $1 million, just to make the math easy, if I stayed invested for that whole period, I did experience that decline, but I also got to participate in the recovery after that. I was actually better after that recovery happened. If I remained invested for the full quarter, ended up with an additional $67,000. If I sold after that decline and then the very next day bought back in, I sat on the sidelines, so to speak, for one day, I wouldn't have fully recovered my investment. I still wouldn't be back to where I was to begin with. And if you see, as you go to the right here, if I took a week off, 2 weeks off, 3 weeks off, it gets progressively worse. And it just takes me back to when I talk with folks about why remaining invested is one of the most powerful things you could do to grow your money over time, participating in the markets. This is a perfect example of that in a very short amount of time, we got to see this play out. But that's why remaining in the markets, not trying to time jumping in, jumping out, can be so impactful and makes a big difference. Looking at the US dollar, the US dollar continues to be very strong relative to other currencies around the world. Just as a reminder, when the dollar is strong, it's a double-edged sword. So it's great for us as consumers when we're buying goods overseas. It's less helpful for us as investors when we're taking dollars denominated in the foreign currency and they get converted back into US dollars. It's a little bit less helpful there. But US dollar, historically speaking, continues to be very, very strong. And since there's an election coming up, I can't let that go without sharing this with you. There are a lot of opinions on the election, and I certainly count myself in that as well. I've got opinions. But what I want to encourage you to do is keep in mind what that can do if you let those opinions creep into your investment strategy and why you should separate those things out. This chart right here goes back to around 1896. And we can look at if somebody only invested during the Democratic administrations and somebody only invested during Republican administrations and what that would look like over that time. And then the line on the top, the one that did much, much better, is the person who stayed invested throughout both, who just remained invested the entire time, got to benefit from compound interest, did not jump in, did not jump out. Now, I'm not saying don't have opinions on our politics. I absolutely do that. But as Americans, we've been blessed with lots of good things from a financial perspective. And one of those is our financial markets. Participating in them is one of the best things you can do to be able to grow and be a good steward of your money and leave the politics through other parts of life. And finally, just a couple of reminders about that are important things to keep in mind. Financial planning is a process. It's not an endpoint. It's important to concentrate on long-term goals and objectives. Focus on reaching your goals, not necessarily beating a benchmark. Maintaining a disciplined approach in the good markets and the bad markets. Investing broadly and globally is important. The asset allocation is a key part of that. Reducing investment and tax costs whenever possible, and then rebalancing as necessary. And that takes us to the end. So my thanks to you. Thanks for joining me for this. May God bless your family and have a great day.